So attendees will start coming in, but we are already to 3 minutes in, and I would like to start. So welcome everybody to the webinar today. Thank you for making it in. We are very excited to welcome a panel that's really the set of experts we could think of in this space, which at least to a retail investor like me is something nice, but still not as well understood as I would have liked it to be. There's a whole spectrum of impact investing. And we've been getting a lot of questions from our customers on, yes, impact investing, does it make money? Is it charity? It is not charity. It does make money, makes real money, because you can do good things and still make money without having to, as long as you share equitably, there's room for everyone. And so we thought it best to talk about the whole spectrum of capital, from traditional make returns and make me more money to charity, but somewhere in between, where you are doing sustainable investing, where you are doing impact investing. And there's a whole bunch of things. For a lot of people, they all sound the same. Some think impact is climate, something impact is diversity, and they all have a version which they have heard based on media headlines. And so today the goal is to talk about the spectrum of capital that's impact investing. And we want to talk about the kind of deals, how it should fit in everybody's portfolio. How much is obviously an individual question, but hopefully everybody has some version of it. And of course, we will talk about Theia partners. So excited to work with you, Rodney and Jeff, on that, and leave, hopefully, after all of this, some time for questions. So with that, I would like to introduce all of you to our panelists. We have Marc Foran. He's the Chief Investment Officer at Raleigh Assets. Marc is an amazing person and a resource in this space. He has seen both the capital markets world and the impact world and everything in between. He has executive experience leading investment management organizations for his entire life. He is very open, as I have discovered in my conversation, to creating novel and new kind of strategies and new kind of ways of doing investing, especially in the ESG space, both across public and private. So welcoming you, Marc. Next up, we have Rodney. Rodney, it's an honor to meet and work with you and Jeff on this project. Everybody knows Rodney, kind of, in this world, for his leadership in sustainable building, not to mention all of the awards you've done. You've been in this space doing sustainable buildings and affordable buildings since 2003. You have experience in LEED Platinum certified projects. It's something that I've only studied in school and never gotten to meet people who are doing that. So that's great for me. And he and obviously he has played a role in building the award-winning ZIBI community. And his network and his expertise in this space is unparalleled. So very excited to have Rodney talk about affordable housing and about green buildings and how those can be married together to check off so many boxes that even I'm amazed. So welcome.
You're making me blush, Khushboo. You're making me blush.
Well, it's a privilege for all our customers to hear you. And then we have Jeff. Jeff was a partner at Theia. He brings 10 years of diversified experience in real estate. He specializes in forecasting, securing financing for major projects, like the $1.5 million ZIBI community, which is an award-winning trillion.
Billion.
Yeah, billion.
Yeah. Maybe trillion by the time it's finished.
We would love that. And that's an award-winning community. And obviously, he has a CFA, and he has, not to mention, amazing finance skills. Like that's not even word bringing to this panel, because that's back of his hand. But it's an honor to have the finance lens to something that for a lot of people, to be honest, is and we get these questions all the time, is very fuzzy, but there's hard numbers to it. And it's exciting to say it's sustainable because it hits this number and this measure, than saying, oh, generically it is doing good. So very, very excited to have you, Jeff, as well.
Thank you.
All right. So with that, I would like to kick off the webinar and start by maybe talking about what I was alluding to is the entire spectrum of impact investing universe. And Marc, maybe I will start with you this time to just lay the context and give us an overview.
Yeah, sure. Happy to. And I know for people that are new to impact investing, there's a lot of terms that get thrown around. You hear responsible investing, sustainable investing, ESG, and it becomes a bit muddled to know what is what and how to look at different investments. So maybe I can kind of start there to level set in terms of terms so that we know what we're referring to. So sustainable investing is really the spectrum of investing while having some form of consideration for environmental or social concerns. And if you start going from, let's call it left to right, along the lower end of sustainability to impact, which is really in the deep end of the pool, the very first pillar there would be avoiding harm. So that means investing in a way that you're not creating negative impacts, because at the end of the day, every single investment has an impact of some sort, be it good, be it bad. So that's strategy number one. The second one, which is sort of in the middle, is ESG, which is probably a term that I would say a lot of the listeners have heard of before. And ESG is the concept of looking at environmental and social considerations and risk factors and understanding how they're going to affect the price of the asset, right? So it's kind of more of a risk metric. Now, if we go to the deep end and go to impact, it does do ESG in terms of analysis, but it takes it one step further, because rather than solely looking at the environmental and social factors and how they impact the investment, it looks at how the investment influences those environmental and social characteristics. So with impact, you're intentionally looking for a social or environmental positive outcome alongside a financial return. And that financial return piece is very important because it's not charity, it is investing still. When we sort of look at the entire spectrum of what is in the capital asset class, really the space has grown considerably, even in Canada. It's been very mature in Europe and Asia and also in the United States for quite some time. And it's a much larger space, I think, than people actually realize. The space of impact investing really runs the gambit of asset classes. So sure, you'll see some traditional investing such as public equities that would be impact. You'll see it in public bonds, green bonds, social bonds. But certainly there's actually quite a vibrant market in alternative assets, that being private equity, venture capital, and also in private debt circumstances as well. And you're even starting to see pretty creative alternative type of vehicles, right? And so we have Theia partners here with a real asset base, looking at impact as it pertains to housing. And at the same time, we're also seeing things in our universe like impact litigation, which is an entirely new field, not related to a direct asset class, but looking at an alternative asset class to deliver impact outcomes for communities that may have been harmed, let's say, by a corporation. So really, impact is spreading across all the various asset classes, and you can find it.
Thank you, Marc. Thank you. That was very helpful. So now let me turn, and maybe this is my application of knowledge and almost a quiz of sorts for me, at least. So Rodney, Jeff, Rodney, where do you think Theia Partners Fund in this spectrum from the lower end of no harm to the other end, where would it fit, or which ones would it fit?
Yeah, we've always focused on the impact side of that spectrum, right? For us, it's not just about limiting harms. Certainly that's a part of it, right? You know, as we start thinking about sustainable materials choices, as a for instance, when it comes to doing work on our buildings. We're looking to minimize any harm aspect, but we're looking to go much further, right? How can we leverage our projects to create environmental and social gain? So that's always been our modus operandi, to be on that impact side of the equation. And I think we're a little bit unique too, in that that's all we do. Every project we do aims to be on that impact side of the equation. It's not like for Theia that there's an impact side of the house and a traditional or conventional investment side of the house. Everything we do rests on that side of the spectrum.
So maybe you could take a moment and explain a little more about the framework that you guys are using to define the impact component, and tell us a little bit about the project as well, which, by the way, for our end customers is listed on our platform and is live right now for investing.
Sure. Yeah. So we have a green affordable housing fund that's listed on the platform. And the premise on that is relatively simple. We, when we were developing the ZB project, which is an amazing project, people want to look at the impact work we've done there, you can go to zb.ca/sustainability, and you can see reports that we've done on our impact framework on everything from sustainable food to materials choices to a zero carbon district energy system. But we saw how long and how expensive it is to deliver on new housing. New development in this country takes forever and really does not come cheaply. We need it. We need a lot more of it, but it's a tough game, that's for sure. And meanwhile, while we were doing that, we were seeing these older apartment buildings, in some cases, 800 meters from the ZB site, that were getting swooped up. We're getting, the tenants were getting rent-evicted, thrown out. They were aiming to convert these to luxury units. The rents were going through the roof. And so we thought there's probably a better model here. And through that, we developed a green affordable housing fund, where we're going and acquiring what we call naturally occurring affordable housing, right? These were apartments that were built in the 60s, 70s, and 80s. They weren't built as social housing. They were built by market operators to be market housing, but they're simple buildings. When you walk by them, they're not going to be on the cover of Azure or Dwell magazine, but they provide great housing. And typically these buildings have an old boiler down in the basement, usually gas, sometimes oil. Everyone's heat is baked into the rent effectively. And so they're the kind of buildings that you go by in January or February, and oftentimes you'll see people with their windows open and their heat turned to 30 degrees. So they're a kind of environmental pigs, but they are quite affordable housing. And so what we've been doing for the past couple of years is acquiring these buildings, slowly getting them off of oil and gas, improving the environmental performance, keeping those tenants in there, using a CMHC financing tool called MLI Select, and maintaining them as long-term affordable units. And there's a great investment story on that. It's been returning to our investors a pretty consistent 12% net IRR to the investors. So there's a good impact story, a good impact narrative, a great environmental story, and a good affordability narrative.
Thank you, Rodney. That was very helpful for us to make that linkage to concept, to what does that mean in real world. And I know just before we started on the webinar, you were saying how your fund, there are lots of ups and downs and a whole bunch of things that were not forecast when you started out, and it's still returning what you had. Turns out all the things balanced it out and still returning the same kind of IRR that you had forecast a long time back, which is sustainable returns, I guess.
Well, it speaks to how resilient affordable housing is, that there's a tragic shortage of it in this country, and it's an incredibly resilient asset from that perspective.
Yeah, that's a fair point, because a lot of the affordable housing rentals are less volatile, because it's not luxury spending. It is not an emotional spending. This is this is it kind of a spending, and it's a more
Yeah.
function spending.
Yeah, and I was just going to say that, so the vacancy rate in Gatineau is 1.1%, which is extremely low. But when you dig down and you actually look into the segmented unit pricing, a unit below $1,500 a month is less than 1% vacancy. And if you go even further down, a unit below 1,000 is less than 0.5%. So most of our portfolio is within that range. We have units renting at as low as $350, but typically on a new unit turnover, we're going in there and doing, typically we'll try to preserve the wood floors. We'll try to preserve the kitchen cabinets, whether it's just changing hardware to keep the renovation costs down so that we can keep that unit rented at below 1,500. Because we know that there's a serious shortage of those units. The demand is significantly high at that price point. And then it also does allow us to qualify for this financing through CMHC, which is MLI Select. You can't meet the affordability targets on new construction using MLI Select. But with these Class B, Class C apartment buildings, if you're doing modest renovations, you can continue to keep rents in that range.
Wow, that's amazing. And that makes so much more logical sense, which is a good segue for me to say, let's stay with you, Jeff, and like tell us, like, one of the questions that comes to people's mind all the time when they're talking about impact investing, is it a trade-off between returns and choosing impact? And from the conversation we just had, it seems like maybe not. Like, it is not crazy, but
yeah, I mean, it depends on the investment vehicle. Obviously, there are some deeply impact operators out there that are offering subsidized rents and much, much lower returns where there is a trade-off. That's not the space that we're in. We are looking at these apartment buildings, and when we have a unit come for rent, you could go and spend $50,000 and potentially get $1,600 in rent, or you can spend $20,000 again trying to reuse the materials that are there and using modest upgrades and getting maybe $1,400 in rent. So the actual ROI is very similar. Maybe you get a slightly higher ROI on the more luxury renovation, but then you get precluded from getting that financing. So anything we give up really on the rent side, we make up for it on a lower cost of capital by applying through the MLI Select program at CMHC. So really, for us specifically, there's no trade-off. Maybe a slight negligible trade-off, but nothing. Like I said, like, we're not a not-for-profit offering deeply discounted rents and offering 4% returns. That's not us. Our trade-off is quite minimal.
Yeah, Khushboo, there are some amazing organizations, and I know Marc would be familiar with many of them, that are doing, community bonds and doing and delivering, whether it's green energy or whether it's affordable housing, and offering, relatively modest returns from the financial perspective. We're offering 3.5% or 4%. For us, we're aiming for scalable impact, and when it comes to aiming at scalable impact, we really felt like we needed to create market returns, right? That's where you're able to attract serious investor attention. We actually think when you start looking at a risk-adjusted basis that our investments perform as good as anyone across the table, whether it's conventional or otherwise, in terms of, because we're not aiming to renovate tenants, we're not aiming for using extremely high debt coverage. We're able to acquire things off market, that we get these series of advantages that keeps us out of the front page of the newspaper. It keeps us out of tenant rent strikes. It allows us to acquire sites before they ever hit the market, because people are phoning us with these kinds of opportunities, that we actually think, again, from a kind of risk adjusted basis, we perform as well as anyone across the marketplace.
If I can just add one piece on the returns and the perception of returns, broadly speaking, I get this question all the time when I talk to investors new to impact investing. And there's a perception out there that doing good implies an additional cost, right, to whatever investment you're talking about. And, you know, I think has been mentioned here, sometimes people might say, I want to do an impact investment. It's going to be a debt issuance of 2-3%, which is obviously quite low. But that's by design, not because that's all that can get structured out there. Where the mindset really needs to change, and this is why impact investing is taking off so much, is that there's a lot of opportunity in doing well by the world, be it for social purposes or be it for environmental purposes. I mean, that fundamentally for people, having a world that is better, more inclusive is desirable. There's value in that. And there's also a lot of opportunity for returns when associated. And so when you recognize that there's these investments, very similar to what Theia Partners is doing here, that can actually generate a return by doing well, by meeting a need that is required. Then you start recognizing that, you know what, you can actually build an impact portfolio. There's lots more that's out there where you have those market type of returns. In fact, that's the most dominant piece, I would say, market type returns within the global impact investing space.
Yeah, that's
really well put, Marc.
Yeah, so I was saying the same thing. That's a very well yes, explained thought. And I totally agree, like doing good doesn't have to come at a huge cost. And that's a misconception, but that's so embedded that people just assume that if you're doing impact investing, if you're doing sustainable stuff, it's a trade-off between what I think media and Hollywood and like just movies characterize as people making a lot of returns are not the good people. It's like that psychological embedding almost to say to be able to make any money, you have to be really bad, which is not true. And there are enough economic research and studies that indicate that that sustainability or diversity is actually improving the economic performance. It increases the pie. When we started at BuyProperly as a platform for fractional investing, we started out with single family rental properties. And one of the things we were doing was make them energy efficient. I mean, my house is retrofitted with smart, energy efficient elements. Everything from lights to lights, switches, vacuum cleaner, you name it. If there's an appliance, it's probably on the green side, probably LED, probably smart sensor controlled, all of that. Because the energy saving cost was enough for the initial upfront appliance cost to pay up. And like when we did our retrofitting, it was only 2 years. It would break even in 2 years. And then it was a positive contribution where our total operational costs were lower. So all our residential properties were changed into smart meters, smart lights, sensors driven, LED, everything we replaced because we knew in 2 years you break even. And it is making economic decision to do that. So I don't know how or what we could as a society do better. Maybe Rodney, Jeff, Marc, you guys need to be in media more. Rather than saying we are not making headlines, maybe you need to, so you can actually dispel some of these myths, to be honest. I will pause for a minute because there's a question linked to this. And Jeff, Marc, Rodney, feel free to answer this one. Probably Jeff and Marc are the finance people, but Rodney, I don't want to underestimate you. Are there any tax benefits also that are attached with impact investing? Jeff, do you think there is one?
There is a tax benefit when it comes to depreciation on green assets. You can have a more aggressive depreciation schedule, which obviously reduces the taxable income for investors. For what we're doing in the housing fund, I can't think of any tax benefits off the top of my head. But for some of our other projects where we're doing green infrastructure and green energy, there are some depreciation benefits related to that.
Yeah, I don't have anything to add to that point. From a tax benefit standpoint, I think that's correct. You do see tax exempt organizations such as foundations making investments, and candidly, oftentimes on the debt side, those are the type of investors that'll make the below market, quasi catalytic investments, so that market rate returns can come in and you can layer that onto an investment. So tax strategies are used to sort of engage impact, but in general, there's nothing specific in terms of treatment for impact investments. Though I have to admit, the concept has been brought up before as a really interesting way. Can you imagine if there was a tax exempt way to engage your assets for impact investing, what that would do? It could be very significant, but I'll say right now that's been on the boardroom board for many in terms of conversations.
Got it. Cool. So, how should impact investing fit in a portfolio? So, again, before anybody answers anything and before I say anything, BuyProperly is a tech platform. This is not financial advice. This is not tax advice. You will have to speak to your financial planners and advisors, and this is not a recommendation in any direction. Before I open this question, but and maybe you guys can talk about your own portfolios as a reference if you're willing to share. Is like, how do you fit impact investing in your overall portfolio? Because the assumption is that in a diversified portfolio, every kind of investing has a play. So, Marc, maybe you could start that.
Sure, and it's absolutely proper advice to tell everybody to recognize that their investment situation or unique circumstances will obviously be for them. The way to really look at impact is to think of it as an optimization exercise in your portfolio between the returns you need, the liquidity, the risk that you're looking to take or willing to accept, and that impact inflection point as well. And so, to the point that there are instruments available within the asset classes that achieve your objectives along all those dimensions, including impact. That's where you start engaging your portfolio. And candidly, amongst our clients, we have some that have a carve out, let's say 5 to 10% of their total portfolio in terms of impact, because they're kind of new to it. We refer to this as the impact curious, right? Not sure what it is. Some people are saying it's market returns. They've heard differently. And we have it right up all the way to those that have 100% impact portfolios in a mix of asset classes, certainly not in just public markets, a pretty significant alternatives component to that. Really what you do find is that those investment opportunities are out there, but there may be other things that you want to do to complement your portfolio with because you have a unique liquidity situation, right? And perhaps that instrument's not available. So it really depends on the individual to explore, and ideally a good advisor that knows the impact investing spectrum. But I would say there's increasingly those that are out there that can talk about how to generate and create a portfolio that meets those objectives. And again, with market rate returns, which I think is really important.
Thank you. Jeff, Rodney?
I don't think I have much to add. Just to be careful on the greenwashing out there, because it does exist. I remember, I think it was a couple of years ago, the S&P released their S&P ESG index, and it had ExxonMobil in the top 10, which they took a little bit of heat for. But no, I think it's important just to align your financial objectives with your social values. And I know us at Theia, that's what we look for when we make investments, that, these investments are aligning with our values.
Got it.
Yeah, I would just say, that the vast majority of my own net worth is tied up in investments that are deep impact. And, I'm reading Morgan Housel's The Psychology of Money, and he does a good job of explaining about which is a great book, actually, for people interested. Yes. But money's a tool for happiness, ideally, and for creating results that align with your values. And so, traditionally, I think people have limited the kind of values piece to philanthropy, the organizations that they care about. But what's so unique about the work, that Rally's doing and that we're doing is that now there's this new opportunity, or relatively new opportunity, where you can actually sort of say, actually, you know what, I don't need to limit the impact side of my life to philanthropy. Actually, if I care about climate change, if I care about affordability, if I care about inclusion, if I care about reconciliation, if I care about health issues, wherever it might be that where your passion lies, there's amazing, impact investments that lie in all of those categories.
What one maybe quick addition that you just triggered in my mind, Rodney, to say there is that when you create a portfolio, and if we talk about traditional portfolio metrics, diversification always comes in, right? And so interestingly, as you design a portfolio, the more impact areas you're looking for, right? So different areas within social, community, within environmental, could be housing, it could be renewable projects, you name it. The more your set of diversification and the better your risk-adjusted returns will be in your portfolio over time. So interestingly, by embracing an idea of doing more impact, you can engage more of your portfolio.
Yeah, super cool. And Rodney, that book, Psychology of Money, I feel like every 2 to 3 webinars in, it comes up. It is such an amazing book. I feel like everybody should
connection lost.
Read it because it just
Market
it has
reestablished.
Uh-oh.
I'm not sure who that is. That's okay. Cool. I mean, I'm learning from you guys. I will be very honest and transparent. I have made some charitable donations, but I have not done intentional impact investing. I think this would probably be my first time doing an impact investing, even though I try to have a diversified portfolio as much as I can. And I think I'm somebody who believes in impact. Like, I make sure my money and my dollars are going to coffee shop and businesses owned by women and diverse founders. And like, I do that actively in like everyday things I buy, I wear, I shop. But impact investing is that other venue where I can make larger impacts than the $5 coffee that I'm constantly giving to a women-owned business, for example, which I can continue to do because that's spending, but then the investing pace is different. So it's a very interesting area that I'm dipping my toe in. Theia would be my first investment. And we talked a little bit, and Jeff, you brought this up, was greenwashing. It's a term I have realized that the people who have had a brush with impact have heard it. And so they were even the impact curious term that I think Marc used, to saying people who are curious, they come and they hear greenwashing, and I have seen them just go, I was like, oh, I wouldn't even know whether it's greenwashing or real. How do I differentiate between those two? So maybe we could talk a little bit about some of the measures, like real metrics, and how do you know it's not greenwashing and it is real? If we are, yes, even if we believe in, how does a regular person who's not going to get into the details and is not well versed make that differentiation? Jeff, since you brought up greenwashing, I will start with you this time.
Well, there's lots of different ways to measure it, and I am a big proponent of it's difficult to manage if you're not measuring it. There's some things that are easier to measure than others when it comes to impact. So for our funds, obviously the easiest one would be affordability. How many units are meeting a certain requirement, and that's easily definable. We have those numbers at our fingertips, can report on that at any moment. Some of the other items that become a little bit more challenging would be, waste diversion. We're not weighing our waste at a unit renovation. Cost benefit of that wouldn't make sense, but we know we're doing the right thing when we're refinishing a parquet floor instead of ripping it out and putting in luxury vinyl, which is a product of choice for some of our competitors, which is terrible for the environment. So there's certain things that are a little bit easier to measure. Like water efficiency, for example, in Quebec is hard because the buildings are typically not metered. That doesn't mean we're not going to put in low flow fixtures and faucets we're going to do that anyway. It's just going to be a little bit harder to measure it or quantify those savings. So we typically have, I think it's about 9 areas where we will report on. We'll have targets for it. Some of it will be qualitative. You won't be able to measure it with numbers, but we will have targets and we will report on those targets every year. And I think just simply communicating and writing down those targets make you so much more likely to follow through on things. I forget the statistic. It's something like 50% more likely to actually follow through once you've communicated and written down that target and sent it out to your investors, or even internally for that matter. Another one that we would be able to measure would be greenhouse gas reduction. So if we have a building that's on gas, we could fairly accurately estimate the greenhouse gases of that building, and then we would know it essentially goes down to 95 to 99% reduction when we switch it over to electric because of the clean grid on the Quebec side. So I don't know if Rodney, if you had any other items you wanted to add, but those are kind of our key things that we look at on our housing funds that we would be measuring.
Yeah, no, I think that's solid. And then, some of this stuff, as Jeff was mentioning, is a little trickier. What we always say is, when I first started getting into it, nobody called themselves a green developer. But then all of a sudden, everyone started calling themselves a green developer, and now everyone calls themselves an impact developer. And there will be a new term in 3 or 4 years that because these terms get co-opted. And so what we always say is you can read the reports, and some people do a better job creating the reports than others. But the best way to see, how am I investing with somebody who aligns with my values, is to see the work they've traditionally done, right? Have they delivered on greenhouse gas savings? Have they delivered on affordability? I won't mention who the competitor is, but Jeff and I just a few weeks ago were looking at this website for a real estate developer. Wonderful website, and the language was incredible around inclusion and impact and affordability and sustainability. Amazing narrative, but the portfolio was strip malls on former farmers' fields, and
one of the first
Mr.
pictures
Lube.
was like a Mr. Lube with this massive parking lot on a green field.
That's one of the things we always say in terms of trying to sift your way through greenwash, is to sort of say, okay, what has this proponent actually delivered in the past? And sometimes, as Jeff was mentioning, sometimes those things are kind of easy to quantify, but and sometimes they're more challenging. But generally, you'll know whether that's a proponent that aligns with your values.
Maybe I could just add one piece to that, though, too. I mean, it's certainly a challenge. You're right about greenwashing, because people love to talk about, all the wonderful things. And candidly, you see this a lot in public markets, by the way. The bigger your budget, the bigger the company you are, the more you can talk about. You got to really get beneath the surface. So as an investor, in Raleigh's case, we develop an entire thesis around what is the challenge, the system challenge that we're trying to address, right? What is the impact we're looking to deliver? What is the expected outcome with that? How could we go about measuring it? What are the metrics out there? How do we see that shaping over time, right? And so that gives you a grounding and a basis by which to engage different firms. So if we're talking about alternatives, we'll put out surveys and make sure that we're getting information. So a lot of great data points discussed here by both Jeff and Rodney. And you could add things such as, who are your tenants? It's low income housing, but who is actually your tenant that's occupying the unit? Is it who you thought it was going to be? If it's a member of a marginalized community that you wanted to provide housing for example, are you actually seeing those residents come in? That would be an example of things that you could do to take a look at it. But greenwashing certainly is something that gets muddled out there considerably, but rules are changing. I'll say that you're starting to see an emphasis, especially from regulators, on making sure that there's minimum reporting standards. And suddenly companies are dropping ESG impact targets, whatever you want, and others are embracing it. So you're starting to see the real opportunities surface more. So hopefully that'll end some of this greenwashing and make it more clear for investors over time.
Yeah, I mean, I think as a women founder of a tech startup, I get exposed to a lot of diversity funds, and honestly, like I feel so many times, more often than not, they're such a waste of time that I am like, just keep me out of these panels and funds. It's okay. It doesn't matter what the language on the website said, or it doesn't matter what panels and what media coverage and headlines were. Reality is very, very different, and I guess the same applies to greenwashing. But Rodney, like when I first met you in Ottawa, I was actually we meet with developers and they all use the same language all the time, and they're all trying to create a community and change the world and like deliver something that the world is going to be very happy about, which is a lot of nice feel good language. But I think it was the first time that I got exposed to real numbers, and seeing that hard numbers. And every time I ask Jeff and you for numbers, like, do you have numbers? Yeah, here it is, there you go. And it's been very easy to actually look at that, and like even for our platform, when we have put Theia partners, we've been able to put the framework you will use. We've been able to put the numbers. To Jeff's point, if you're not measuring, you cannot deliver what you're not even trying to deliver. So I don't remember what the number was. Is it 330 metric tons annually of greenhouse gas emission reduction?
That's our target for Fund 4.
Yeah, I remember that number. It's like there is a very specific number. It's 330, and I remember that number. And yeah, that's a learning for me and for hopefully the audience as well, that look for the metrics, and to Rodney's point, look at whether they have a traditional house and a impact house, or this is who they are, and those are two different things. And I'm so glad to be working with you both, and Marc. Marc, we are not directly working with you, but we are happy to have Theia partners on our platform, and it's good to hear all of these easy to make decisions points. In the interest of time, the last question I want to ask, so we are all here, we discussed what should be doing. So if I were ready to get started now, one of the things the audience can do, and I can say this, is as the CEO of BuyProperly, I can request you to go on the platform and check out Theia partners. Again, it's not a recommendation. See if it works for you, but you will have the metrics and the numbers that's being targeted, as well as the history and their track record of delivering on impact. So it's a worthy project that you can look at right away. What else can the audience do to get started in impact investing today, like now?
I'm happy to kick that one off, because I'd say that there's an increasing amount of literature that's out there, but at the same time, I know that it can be, somewhat confusing. Still, if you actually even just go and get on your Google and start looking up impact investing, one of the best ways to do it is, what asset classes you're looking for in your portfolio. You can do just at-home research to figure out, what does impact investing look like for bonds? What does it look like for real estate? What are the opportunities that are out there? What does it look like for private equity, if that's an area that's of interest to you? And so on and so forth. And you'll start realizing, and this happened to me when I moved from traditional finance and investing. I've really been in that for the bulk of my career, but then moved over to impact investing through learning more on my own, right? And so I just encourage everyone to just do your research, and then ask, if you have an advisor, ask them the tough questions, network, talk to people. Impact investors love talking about this, because we know that the more informed people are, the more impact investing will occur. So that would be my strongest advice. Just go do your desk research, get the conversation going, and keep learning.
Thank you.
Great
Rodney?
advice.
Yes.
Oh, that's great advice. I don't have anything to add to that. I will, say one of the things we're always looking for new ways to leverage the work we do for greater impact. And one of the things we like about BuyProperly, we've told you this before, Khushboo, is that traditionally, unfortunately, the private placements in real estate have been very, excluded to a small number of people, and very much, an old boys club of accredited investors and limited number of institutions. And one of the things we like is, this kind of democratization that happens of access to investments. And, we think there's a great narrative on that front in terms of opening up these opportunities to a greater number of people who traditionally wouldn't have had access necessarily. So we're appreciative of that, that's for sure.
Jeff, do you have anything to add?
No, I don't have anything to add to that. That was well put, Rod. And Mark.
I have a question from one of our attendees. What if you know nothing about investing, but just want to invest in something good, clean, and have $5,000 with no advisor? It needs to be easy to get people to do this with me. It's a big rabbit hole. Is there an impact investing for dummies?
I'm sure there is. I haven't been to chapters and looked at that section in a while, but
it's an interesting question. I totally appreciate where it's coming from too. It also explains why investing candidly is hard, because even if we just remove the impact element, you run into the same issues, which is what's right for me. How do I know what these different instruments are? What do they do? How do they act? How should I anticipate this? Will it meet my needs? It's no different in impact investing. The only difference really being is that you're going to know what your social and environmental outcomes are, right? I would really say the best thing to do is, again, network, talk to people, learn that way. I think that's probably the best way one can get informed, because the one thing I would encourage you not to do is just go out there and try to make an investment that you know nothing about just because it does well. It may not be suitable for you. So, best to understand what it is that you're getting into and actually do that homework and take the time.
Yeah, when I was researching this, my own research, and I came from a zero knowledge. I know a little bit about investing. Again, I don't have a CFA. I'm a basic MBA finance that knows basic Excel. And when I was researching, I think Google was a great tool because and maybe after this we could do like a blog or something, but on Google you can actually get a spectrum which says, here is the spectrum, these are the terms used if it refers to your point, not harming people piece is here, this is the term used when you're referring to this is the term used when you're referring to this. And so there are these spectrum of capital, sort of, what do you call that? Like a heat map sort of thing, which will inside that layout. That's what I use to give myself a starting point. But the interesting thing to what you were saying, Mark, is then if you start reading, you realize that it isn't a separate asset class. And I'll use the worst analogy maybe to investing. It's like eating healthy. You don't have to be a nutritionist, but once you know you are trying to avoid whatever it is, trans fat, you're trying to avoid refined sugar, you start learning how to read ingredients, what to avoid, how do you read calories, is too much sodium good for me or not good for me? Likely not good for you. And so if the ingredient says too much sodium, even if you like empirically don't know, you know that if the sodium number looks very high, maybe it's not good for me or my body. And then after a few attempts, you get a broad sense of what to deep dive on in reading the ingredient list and what to avoid. Like you get a sense of it, and that doesn't make it universally true, but it is a good guidepost, and you do it a few times, you know how to avoid and what to avoid and what is okay and not okay. And I think that's my way of learning new thing is just attempt a few times, use a few calculators and tools, and there are a bunch of those out there for impact investing also, and then learn through that, and then after a while you know what to look for. You don't know the answer, but you know what to look for.
Yeah, if you're buying real estate and you want to know, what is there a social or environmental aspect to the real estate? It's the same as a traditional real estate investor. And I'll tell you, like, impact can even be in things like, people don't think about this, but GICs. Go to the financial institution and say, what are you doing with the money? Right? As an example, right? And that's, a very low risk kind of investment that one can make, but there are impact GICs out there, even on that end of the spectrum, right? Which is just cash-like, all the way right through alternatives to, let's talk about venture capital as being a more risky asset class. Generally speaking, there's impact opportunities there. So you really have to find what's right for you. And that's why, understanding, and I like what you said, Khushboo, about the fact that impact investing is not a different asset class. It's in the same asset classes that It's just that there's an additional element to them in terms of additionality and intentionality for an environmental and social outcome that might resonate with you. So if that's what you're looking for, understand that asset class and that investment and what you're getting into.
Cool. That's all. I think we have a question, and I'll open it for questions for everyone. Love this analogy. Thank you. Thank you. I'd love a primer on your company. I would love that. I've watched a couple of your webinars and I love what you do. I'm still not sure exactly how to go about making a wise decision on investing. Thanks. Okay. Appreciate that. I don't have the name, but whoever said that, thank you so much. We'll be happy to host more webinars. I think democratization is not just bringing deals. It's something we realized very, very early on. Alternative assets in general, just educating and talking about it in a safe space is just as important as just bringing the deals on the platform. Because then it will be the same old, and the same old people will buy. If new people have to get in, they need to know more. And so we continue and will continue to do more educational webinars.
We have one more question I can answer.
Yeah.
In terms of numbers, how much cheaper is the financing for Theia partners compared to other developers? Other developers can access the same financing if they're doing the same initiatives that we are, but typically the financing that we are getting compared to conventional financing would be around 1.5 to 1.75% cheaper on the interest rate. But you're also allowed to get longer amortizations than you would typically have in conventional financing. Conventional financing being 25 years, you can get all the way up to 50 years in the MLI Select program. And then another benefit as well is typically you could get non-recourse financing. And what that simply means is that just like when you buy a residential property, if you default on the mortgage, the lender would go after simply the property and not you personally. In commercial financing, you typically also have to post a guarantee on top of that, so they can foreclose on the property and go after you personally or your corporation. CMHC does offer a lot of products that would be non-recourse, depending on how many points you get on the sustainability and affordability. So those are the three big benefits: the non-recourse, the longer amortizations, and the cheaper interest rate.
Thank you, Jeff. That was actually an important one, and I somewhere in the process forgot to ask you that, but that's a very important differentiation from other projects as well. Vikas Pillai has a question. To start investment with BuyProperly instead of affordable housing, why can't we have a regular income generator kind of investment in form of fractionalization? What is the trade-off? I am not sure I completely understand your question. Vikas, if you're around, maybe I can unmute you and you can ask the question live.
Hi, am I audible?
Yes.
Okay, great. So what I need to say now, because today's webinar was more about Theia's and the proposition, what they are offering, and I understand from where they are coming. But now my point is that, like, I had discussion with Alpha yesterday, and that's how I'm a part of this webinar. So I wanted to understand that for me, it will be a stepping point to get into these form of investment. But in case if I have to pick and choose, why should I start with Theia, not the other ones which is available on your platform?
Again, I cannot make a recommendation, Vikash. So it is one of the options. Today's webinar is about impact investing. And Theia is one good example of what impact investing numbers and metrics and measures would look like in real world investing. We are at no point saying invest in Theia or not on the others. It will depend on your own financial situation. And yeah, you will have to discuss with an advisor.
My advice would be biased, so I'm not going to give it.
Completely unbiased advice. I love it. I think part of the implication in the question here is, and you know, I'm certainly not your financial advisor, so I want to make that perfectly clear. You should speak to your own financial advisor. But I think the idea is, rather than a single investment, why not a pool of investments for diversification, or a portfolio of investments? And, you know, I think, you know, again, talk to your financial advisor, but one of the advantages with a platform such as BuyProperly is that you have a suite of different investments that are here if you want to diversify, but what that looks like, what the right amounts are, what the right levels are, that's something that, again, you'd have to talk to your financial advisor with. But at least you have the mechanisms to be able to do so on the platform.
Makes sense. I think, yeah, then leave it to me. Let me have a quick chat with my advisor and I can come back to you guys. Thank you so much.
Yes.
Thank you.
Thank you, Vikash. Thank you for asking a question. Cool. Yes, this will be recorded and this will be sent out. There were a lot of people who register each time and are not always able to attend. I think we are out of time, but I see one more question come in. Is this in the context of Theia partners? Jeff, Rodney, maybe you want to take that question. How will the capital appreciate over 10-year period? Say if I invest 10,000, how much capital gains I can expect on exit? And will there be a one-time payment only?
No, so we expect, typically it will depend on the assets that we buy. So if you buy more capital intensive assets, there tends to be less distributions, and those distributions will be lumpy, surrounded around financing events. But typically what we see is there's usually a large distribution around the first refinancing, which comes between year 3 and 6. There would be a large distribution. After year 3 to 6, there would be smaller distributions, and then obviously a much larger one at the time of disposition in year 10 to 11. And so what we are forecasting would be an 11 to 13% IRR. So what that means is if you're putting in $10,000, that would be compounding at 11 to 13%. If there was not a single distribution, all you would do in Excel is you would take that $100,000, you would multiply it by 1.11, and you would copy that for 10 years. The fact that there would be distributions in between now and then will complicate that formula a little bit, but that would give you your range. I tried my best, but I will. We can get back to them at an exact amount on that 100,000. But typically, it'd be about 2.4x your investment. How's that?
How about an infographic?
We could do that too. We could provide that, Khushboo. We can provide that after this. We can show the initial investment. We'll use like 100 or 10,000 as the example. I think
10,000. Yes.
10,000, and then we can show what the distribution would look like in year 4 or 5, and then what the distributions would look like in years 5 to 10.
Cool. All right. I think we are also out of time. So thank you, everyone. Thank you, Marc, Jeff, Rodney. It was a pleasure having all of you on the webinar. And hopefully our attendees got enough information to get started on this journey. I am actually very excited to go do my first investment right after this. I was waiting for the webinar and asking my questions to make sure my information is correct before I make my investment. So thank you so much for joining, and Have a good rest of the day, everyone.
Thank you, Khushboo.
Thanks, everyone. Yeah,
Thank
thanks,
you.
Khushboo. Thanks, Marc.